Polls.
Thank you for having me.
Yeah. And we thank you for being here, Barnaby.
Okay, let's unpack this. For decades, you were right there in the trenches, and we're talking about way more than just collecting rent, right? You were sorting out, I don't know, municipal water issues, unclogging drains at 3 in the morning, and maybe the biggest job, you were the chief diplomat. Yeah, keeping the peace between neighbors at your mobile home park. It was demanding, totally all-consuming work, but, it was yours. Then finally, the moment you've been dreaming about. The park is sold. That check clears, and that massive wire transfer hits your bank account. Wow. Now, for most owners, that sale feels like it. The finish line. End of the story. But we're going to challenge that idea today. What if that sale? What if it's actually just the starting gun for something much bigger? Maybe it's just the end of Act 1.
That's such a great point. What's really fascinating here is that the physical transaction, selling the park, that's often the simplest part. Really, the truly complex work, and honestly, the rewarding work, it starts the day after that wire hits.
Yeah.
So our mission in this deep dive is to really analyze the strategy for what comes next. How do you turn that huge pile of capital, and just as important, all that hard-earned experience running the place, how do you turn that into a real legacy, a lifestyle you actually want, and ultimately become a legend in this space?
Okay, so the sale closes, and the first thing that hits you, that's not the sound of money, is it? It's the silence. Suddenly, no more calls about leaky pipes, no Monday morning rent collection stress, no late night panic texts about maintenance. And at first, that silence feels like, pure freedom, absolute bliss.
It really does, for a while. But, we see this consistent theme in the source material we looked at. Pretty quickly, for a lot of these longtime owners, that freedom starts to feel like a genuine loss, sometimes even depression. They haven't just lost an asset, a piece of property. The key insight here is that the seller didn't just sell dirt and homes. They sold purpose. They sold rhythm. They sold their daily routine, the whole structure of their day.
That's heavy. Because the physical thing is gone, the park, but the identity, right? The park owner identity, that kind of sticks around.
Exactly. We talked to one owner, owned his park for decades. For months after the sale, he told us he found himself calling his old manager every single morning, just asking, what's the occupancy? Did the city approve that variance yet? Stuff like that. He wasn't trying to meddle with the new owner. He needed that routine back. So this next phase, it begins not with money management, which is what everyone assumes. It starts with identity management. You have to actively figure out, okay, what's my purpose now? Honestly, the hardest part of letting go often isn't the property itself. It's losing that daily purpose it gave you for maybe 20, 30 years.
Okay, so if the loss is purpose, not property, then the solution has to be finding a new purpose, a strategic one for all that capital that just landed. Which brings us, naturally, to the money itself. That buyer's wire hits the account. The old thinking says, great, I retire, park the cash, live off the interest. Simple. But you're saying, hold on, that cash isn't retirement savings to just sit there. It's raw material. It's fuel for the next strategic move.
That's exactly right. That cash, it really cannot just sit idle. That's a huge opportunity cost.
Right.
What we see is that smart sellers, they successfully convert all that active management experience, all those headaches, they convert it into passive wisdom. Wisdom that generates pretty substantial returns, often with very low effort compared to running the park. The real challenge is shifting your mindset, right? From managing one complex, high liability asset, the park, to financing multiple, simpler, lower liability assets. And we see 3 key strategies for redirecting that capital pretty much right away.
Okay, let's break those down, because this is where the strategy gets real, where it moves from just an idea to actual steps you can take.
Okay, first one, it's often the easiest. Seller carry notes. This is classic low-hanging fruit. Basically, you, the seller, finance a chunk of the purchase price for the new owner. You become the bank on your own deal. So instead of getting one massive lump sum, maybe you get a slightly smaller lump sum up front. Plus, you get a reliable monthly interest payment. We often see rates around, say, 6 to 8%. You're essentially turning that new buyer, who you've already vetted, into your best borrower. It keeps you involved financially, which can be comforting, but boom, all the operational risk gone.
That sounds much safer, yeah. But I guess you still have some risk with that new owner, right? Counterparty risk?
You do, absolutely. But the risk profile is totally different. It's way lower than managing tenants, dealing with infrastructure failures, all that. And importantly, it's secured by the property itself. If they default, you potentially get the park back. Okay, the second strategy is moving into private lending. This is where you take that capital and start funding other trusted investors' real estate projects. And it doesn't have to be just mobile home parks. Often it's multifamily, self-storage deals, maybe small industrial properties. You can achieve similar, sometimes even better returns than your park was giving you. But here's the magic part. With zero tenants to manage, your main job becomes vetting the borrower and their management team, not fixing toilets.
Zero tenants. That definitely sounds appealing. But doesn't that require a different skill set, maybe a higher level of financial know-how? You're putting capital into deals you don't directly control.
It absolutely requires a shift in expertise. You're moving from, like you said, fixing plumbing to vetting people, vetting deal structures, understanding loan documents. You're essentially trading day-to-day operational control for scale and passivity, which is the goal, right? And that leads to the third strategy, which is perhaps a bit more sophisticated. Taking preferred equity positions.
Okay, explain that one quickly. What is preferred equity?
Sure. Think of preferred equity, or brief as it's often called, as an investment that sits somewhere between debt and regular equity. It kind of looks like debt because it usually pays a fixed return, like interest. But it acts like equity because your return often depends on the property's success. Here's the key. When a real estate deal makes money, the preferred equity investor gets paid their fixed return before the main owners, the general partners or common equity holders, see a single dime. So your goal shifts completely. You spent maybe 20 years physically fixing pipes. Now you spend the next 20 years financing the systems and the people who fix the pipes. There's a great quote related to this. Passive income is just active wisdom that's been paid for.
I love that. That really connects the past hard work to the present strategy.
Okay, let's talk about that wisdom itself. Because every decade you spent owning and running a mobile home park. That's like earning a PhD in affordable housing operations, right? That experience navigating the regulations, the big capital projects, the tenant issues, it's a goldmine.
Yeah.
And smart buyers, new operators, they will absolutely pay to tap into that knowledge.
They should. And they do. You've built up this incredible amount of, well, hard-won institutional knowledge, stuff you can't learn in a book. So how do you turn that experience into, like, actual equity, something repeatable? It's pretty straightforward. You consult, you coach, you maybe partner on a small scale, you teach. Think about all those stressful late-night calls you used to get about, I don't know, a mainline break or navigating some new local ordinance, like maybe new septic regulations pop up in your state. That specific experience, that now becomes your curriculum. All those scars you earned from ownership, they become valuable, customized strategy lessons for the next generation coming up. That raises a really important question, though. What specifically does this new generation of park investors actually need from a seller like you? I mean, they've got access to online courses, books, podcasts.
Yeah, but they don't need another generic rah-rah guru session or some book written by a guy who bought one park 5 years ago and thinks he's an expert. They need the real deal. They need the unvarnished truth from someone who has actually patched a sewer line in the middle of February, someone who's lived through a full economic cycle, seen interest rates go way up and come back down. They need specific, practical guidance on things like tenant screening in their market, setting up utility billing correctly, navigating the local politics, authenticity. So yeah, you can retire from owning the park, but you really can't and shouldn't retire from your wisdom. That knowledge, if you package it right, maybe through consulting retainers or even taking small equity stakes in their deals in exchange for mentorship, that becomes your new high-margin asset class.
So the wisdom you earned being the operator, boots on the ground, that becomes the blueprint for the structure you need to build now as the architect, looking down from above. Okay, so once that massive amount of cash, that liquidity, arrives, the priority has to shift again, right? It moves away from growth and hustling to, well, preservation, stewardship, protecting what you've built. You've got to build that structure before the temptation to, I don't know, buy a yacht or something sets in. What specific structures are really essential here? Stewardship is exactly the right word. It's the necessary guardrail. Because wealth without structure, I mean, history shows us it's almost guaranteed to disappear by generation 2. That's just a fact. So you need those guardrails in place immediately, like day one after the sale, well before that cash starts burning a hole in your pocket. Structurally, yeah, sellers have got to move beyond just having a simple will. That's not enough. They really need to set up something like a revocable trust or maybe a family LLC for essential asset protection and, crucially, for smooth generational transfer. A trust is usually much better for passing assets privately and efficiently to your heirs, often avoiding the whole probate court mess. Plus, it can enforce financial discipline from beyond the grave, so to speak. An LLC is great for shielding you from business liability, which you've mostly gotten rid of by selling the park, but it's generally less efficient for estate planning. So, for this specific goal of preserving wealth long term, a trust is typically the cornerstone piece.
That distinction is really key. So the trust isn't just about taxes, it's about setting up those guardrails for the future generations.
Precisely. It's about control and intent. You need to name successor trustees, people you trust implicitly, and build firm financial guardrails right into the trust document itself. And then, strategically, think about this. You can use the predictable income stream generated from those seller carry notes we talked about, or your private lending deals, or even dividends from publicly traded real estate investment trusts, REITs, those big professionally managed pools of properties. Use that income to automatically fund specific family goals, education funds, down payments, maybe even philanthropy that matters to you. There's another saying here, an inheritance just pays the bills. A trust teaches discipline. It builds structure.
That's a huge mindset shift, moving from managing a day-to-day business to managing essentially a long-term legacy structure. And speaking of legacy, the seller has already spent decades mastering the challenge of providing safe, affordable housing. That's a huge accomplishment. How do they pivot? How do they shift that expertise and now this significant capital into financing impact that aligns with what they've already done?
This is where the game really changes, I think. It elevates the whole thing. We move into what you might call legacy investing. The seller can now allocate capital to preserve the very mission they spent decades working on, often way more efficiently than they ever could managing just one or two parks. So what does that look like? It means actively investing in, say, affordable housing funds that specifically focus on preserving existing communities, making sure those parks don't just get scraped for high-end condos or fall into disrepair under bad management.
Wow. So they become the capital partner that protects the very kinds of communities they used to manage directly.
Exactly. They've already done the hard work of understanding the nitty-gritty of the affordable housing market. Now they get to scale that impact using capital. And what's really powerful is they can combine this with their mentorship role. They can actually sponsor new ethical operators, people they guide, provide them seed capital, give them strategic advice based on decades of experience, and ensure that the next generation entering the field maintains high ethical standards, keeping the community strong. And then, finally, the key piece of real legacy planning is allocating a specific slice of the portfolio, maybe 5 or 10%, towards charity or conservation. Something tangible that will definitely outlive the financial spreadsheets. Maybe it's funding a local community center or conserving land near the park you sold. Legacy investing really means the seller's name, their influence, still builds roofs and protects communities long after they stop physically working under them. When you start thinking about ROI, return on investment at this stage, the meaning totally shifts. ROI means a heck of a lot more when the R stands for remembered.
That brings us beautifully to the final challenge, maybe the most existential one of this whole exit process. Freedom itself. Because true freedom, it isn't just sitting on a beach doing nothing, right? It's the freedom to choose what actually matters to you now. So what's the risk? You've got the money structure, the legacy plan, but what if you have no structure for your actual day-to-day life?
The risk is huge, actually. The risk is simply reverting back to what's comfortable, what you know, which for most park owners means getting sucked right back into the industry, often just out of habit or sheer boredom. If you don't have a structured plan for your time, your next 5, 10 years, what happens? Every retired owner accidentally becomes an unpaid consultant, constantly fielding calls for free advice. Or worse, they drift back into being a realtor again just to have something to do. They end up fixing someone else's park problems without getting paid for the immense wisdom they bring to the table. It's a waste.
So planning your post-sale life is just as critical, maybe even more critical than planning the sale itself.
Honestly, more so, yeah. Because the stakes are higher now. It's your personal happiness, your remaining time. It's invaluable. You absolutely must set new schedules, find new projects that excite you, maybe even seek out new mentors for yourself. Perhaps mentors in philanthropy or in starting a completely different kind of venture. Learn something new. The point is, your days must be structured by you before the lack of structure pulls you back into the old routine by default. Because trust me, if you don't define your next mission, the industry will call you back. And you'll end up fixing someone else's mess, probably for free.
Okay, here's where it gets really interesting, I think, as we bring this whole deep dive together. The transformation is now complete. The seller moves from being the operator, down in the trenches, covered in mud, dealing with the daily grit, to becoming the architect, designing the future of their wealth, their impact, their legacy, all from a higher vantage point. You get to become that disciplined, wise capital partner that you always wished you had when you were first starting out. Remember those days? You actually get to write the playbook, the real-world playbook you wish someone had handed you back then. And that's how legends are made in this business. Not just by owning property, but by building structure, building up people, and deploying smart, intentional capital wisely.
Yeah, if we connect this to the bigger picture, it's clear. You don't just retire from this business. You graduate.
Yeah.
You graduate to a new, higher level of influence and involvement. When the park itself outlives your ownership term and your equity multiplies far beyond your own needs because you built the right structures, that's when you become a legend. A legend in both the actual real estate and indeed the impact you've had. That whole journey, from trailer park to trust fund, as some might call it, it isn't luck. It's not accidental. It's the result of intentional architecture, an exit strategy that starts way back with managing your own identity post-sale, progresses through disciplined capital redirection, putting that money to work smartly, and culminates in a carefully crafted legacy plan.
And that right there, for you listening, is the final takeaway. Look at your own assets right now. Look at your own decades of professional experience, whatever field you're in, and ask yourself, how can you start thinking about shifting from being the operator to being the architect starting today? How can you turn your own hard-won wisdom into disciplined, perhaps passive capital that serves a purpose bigger than just paying the bills, a purpose that builds a real multi-generational legacy? Think about building that structure. Start thinking about it right now.